Hey, what's up, guys, and welcome back to another video. So today I'll be going over supply and demand. Now, this topic is one of the most misunderstood concepts in Forex. I see a lot of people on YouTube trying to explain how it works, but many of them are just making it unnecessarily complicated. So in this video, I'm going to be simplifying this topic to the way I understand it. So with all that being said, let's get into it. Now, first off, before we talk about what supply and demand is in Forex, we first have to understand what it actually means in economics. Now, supply and demand in economics is the relationship between the quantity of a commodity that producers wish to sell at various prices and the quantity that consumers wish to buy. It's the main model of price determination used in economic theory. The price of a commodity is determined by the interaction and demand in a market. So basically, supply and demand is literally how the world works, right? So we have people who are trying to sell items, who are trying to sell products, and we have people who are trying to buy, the consumers, right? So let's take an example. Let's take Tesla. Now Tesla is a company that manufactures and supplies electric vehicles, that supplies EVs, right? So let's say you are somebody who has a good taste in electric vehicles and you buy a Tesla. So basically, you along with other buyers are the demand, while Tesla, along other companies who supplies EVs, are the suppliers. So it's basically simple. Supply is relative to sellers, while demand is relative to buyers. Okay, now, what is supply and demand in Forex? Now, supply and demand in Forex is the understanding of the balance between the buying and selling pressure present at certain levels in the market. We have no idea of the exact number of buyers and sellers in the market. So therefore, the supply and demand theory allows us to analyze whether it's strong supply and demand. Now, this is very simple. So in the market, we as individual traders don't actually know the number of buyers and sellers in the market. So supply and demand is a way we know who is currently dominating the market, whether it's the sellers or the buyers. So it's very simple. Now, what specifically is supply? So basically, supply just means sellers. In the market, you can either be a seller or a buyer. You can't be both at once. It's impossible. Now, if there are more sellers than buyers in the market, we will say supply is greater than demand. Okay, so this is an image I took from TradingView. This is the chart of gold USD. Now, as you can see, these basically are the supplies. So as you can see from this point right here, from this eye right here, so price came all the way down. So there was an impulsive move all the way down. So this basically tells us that at this point in time, sellers were dominating the market. So the buyers were unable to dominate. So the sellers were just dominating the market. So that's why you see the price came all the way down. So it's very simple. You can also see from this point right here up onto this point right here, sellers were just dominating. First, there was an impulse candle, this big bearish candle all the way down. Now the buyers tried regaining dominance, but the selling pressure was just too high. So price came all the way down up onto this point. Now take a look at this as well. From this right here, you can see there was just big impulsive moves all the way down, right up onto this point where the buyers, were just trying to regain dominance, but price kept going all the way down up onto this point. So basically, whenever you see supply in the market, it just simply means that the sellers are dominating the market. Now, what exactly is demand? Now, demand refers to buyers. So basically, if there's higher demand in the market, that simply means more people are willing to buy than sell in the market at that current time. Now, if there are more buyers than sellers in the market, we will say the demand is greater than the supply. So this is also an image I took from TradingView. This is the AUD USD, the Aussie dollar. So as you can see, as price came all the way down, there was an impulsive move downward right here. So from this low right here, price started going all the way bullish. As you can see, from this point right here up onto this point, the buyers were just dominating the market. Now, even though at some point the sellers, were trying to bring price down, they weren't actually able to gain dominance. Why? Because the buying pressure was just greater than the selling pressure. So this is an example of demand. Now, you can also see right here, as price came all the way down, there was this slow but constant move upward. So as you can see, price was just going all the way up. The sellers, were trying to bring price down, but the buying pressure was just way too high. So price from this point was just going all the way bullish. And you can also see this third example right here. Immediately there was a sudden impulsive candle all the way down. The buyers immediately created a new impulsive candle upward, and from that point on, price started going all the way bullish. So this right here, and this right here is a good example of demand. Now, what are supply and demand zones? Now, this is very important because this is how we're going to be getting our trade set up. Now, supply and demand zones are specific areas on the chart that indicate where price of an asset has historically made significant moves, either upwards or downwards. These zones are identified by observing patterns where price actions are shown a strong reaction, either a sharp increase, that's on the demand side, or a sharp decrease, that's on the supply side. Okay, so how do you define a supply zone, right? Now, the supply zone on a price chart is where traders look to sell the market. The zone is present after a substantial price decrease, which gives big institutions and individual traders like you and I a chance to sell the market. Okay, now back to gold USD. As you can see, this was an example of supply. So price came all the way down right here. Same thing as well for this right here, and same thing as well for this right here. But the thing about supply and demand is, price doesn't just go on a straight line. So immediately price came all the way down. There was so much selling pressure to the point that price has to retrace back to a specific zone in order to continue the bullish momentum. So you basically call this a supply zone. So when there's a massive sell all the way down, you expect price to retrace back into a zone. Now, later in the video, I'm going to be showing you how to identify your zone. So don't worry about it when I'm talking about later in the video. So as you can see as well, price came all the way down. So this basically was the supply. So price went back into the supply zone to pick up the pending orders that were on the sell. And immediately price came into the zone, price started going all the way bearish once again. So it's very simple. Now, what exactly are demand zones? So demand zones are just like supply zones, but basically the opposite. So demand zone is a level where traders look to buy the market. The zone is present after a substantial price increase, which gives big institutions and individual traders like you and I a chance to buy the market. Now again, back to AUD USD. So as you can see right here, this is an example of demand. Price went all the way up. This as well is an example of demand, and this as well is an example of demand. So as you can see, as price went all the way up, you can see there was a massive selling pressure all the way down just to tap into the demand zone. Now again, I'm going to be showing you how to identify your demand zone later in the video, so you don't have to worry about it. So as you can see right here, price tapped into the demand zone and price started going all the way bullish just until there was massive selling pressure once again into the demand zone, and price again continued the bullish momentum. So it's very, very simple. Okay, so let's take a look at some examples on the charts. This is gold USD, and we are currently on the daily time frame. Now, this specifically is where I want us to talk about this section right here. So as you can see, let's take a closer look. So as you can see, price from this high came all the way down. So there was an impulse move all the way down, right? So based on supply and demand, we know price has come all the way down. Price has to retrace back into the supply zone. Okay, now this is going to be our supply zone from this high right here up onto this low right here. So from this high right here to this low right here, this black candle right here is going to be your supply zone. So this is how a lot of people actually draw their supply and demand zone. But I personally like to use the fair value gap. So I like to use the close of the fair value gap to reduce my supply zone. Now, it's not necessary for you as well to use the fair value gap. You can just simply use the high, the first high, and the first low. But I prefer to use the fair value gap. So I'm going to draw this right here. Now let's see what ends up happening at the end of the day. And finally, as you can see, price has tapped into our supply zone. So now let's say you want to get into a trade, right? So what many people do is that they set this as the entry, right? They set this as the stop loss. They basically use the zone, to get into a trade. Now this is very wrong because at the end of the day, you just have less than 1 to 3 risk reward ratio. So there are two methods you can use to refine down, to get a higher risk reward ratio. So I'm going to be explaining the first method right now. We're going to be talking about the second method later in the video. So what is the first method? The first method is simply using the 50% level of your supply or demand zone. So you simply draw your gap box from the high up onto this point right here, and you just simply use the 50% level of your supply or demand zone. So I'm going to refine the entry up onto this point right here. Now, as you can see, our risk to reward ratio has increased from 1 to 3 risk to reward ratio up onto 1 to 7 risk to reward ratio. Now, if I'm going to be honest, this is not actually enough. So let's take a look at the macro structure. Let's have a bigger perspective, right? As you can see, price has been going all the way bullish, right? So price is currently on a bearish momentum. Now, if you take a look at this void right here, right? This void right here, this structure right here, this is the zone responsible for creating the structure, right? This zone right here was responsible for creating all the structure. Now you can see there is no structure on the far left side. So basically this zone right here is a liquidity, right? So if I'm going to set my TP, I'm just going to draw my TP all the way down below this zone right here, because I know price is definitely going to go all the way down below this low, because this low is basically a liquidity. So as you can see, our risk reward ratio has increased from 1 to 7 to 1 to 10. Now this is an incredible 1 to 10 trade setup. Now let's see what actually happens at the end of the day. Now as you can see, price has finally tapped our TP. So it's that simple. When price retraces up onto the supply zone, you do not use the old zone, to make a trade setup, because it's going to be too big. You just only need to use the 50% level. So hopefully price will tap into that 50% level before it continues the bullish momentum. So immediately price has come all the way down, right? Now, on a bigger perspective that price is now on a bearish momentum, right? So what you just have to do is to highlight your next supply zone, which is going to be this right here. So this is going to be your next supply zone. So why is this your next supply zone? Just because this is the first high, and all this right here is fair value gap. All this right here is just basically liquidity void. So price will come all the way up, because there's so many pending orders right here that the market didn't pick up when it first started to come all the way down. So price has to go all the way up to pick up those orders before it continues the bearish momentum. Now let's see what price is going to do next. Okay, as you can see, price is going bullish, and price has tapped into our supply zone. Now again, if you want to enter into this trade, you don't need to use all the zone as a trade setup, right? So let's say you set your entry right here, and you set your stop loss right here, and you set your TP right up onto this point. This is going to be a 1 to 5 risk reward ratio. So all you just have to do is use the 50% level in order to get a higher risk reward ratio. So you're just going to draw out your game box up from this eye down to this level right here. So I'm going to refine this up onto this point right here. And as you can see, our risk reward ratio has increased from 1 to 5 to 1 to 10. Now it's that simple. That is all you need to do to get a better trade setup. Now let's see what actually end up happening at the end of the day. Now as you can see, price is coming all the way down, right? Price is coming all the way down. And finally, price has tapped into RTP. Now, this is a solid 1 to 10 risk reward ratio. So again, price has come all the way down. And for price to keep going bearish, price has to retrace, right? This was an expansion. This was a retracement. This was an expansion. This was a retracement. This again was an expansion. So, price will retrace into the supply zone. Now, where are you going to say supply zone? Your supply zone is going to be from this high up onto this right here. So why did I use this candle? Now some might say, well, you're supposed to use this green candle right here, right? Because it makes sense. If you want to get into a trade, it makes sense to use this candle. But this is not actually an order block. You can do that for an order block. This is a zone. So the supply and demand zone is actually different from the order block. They are not the same in any way at all. So you can see as price was retracing up until this zone, this was a big bullish candle upward, followed by this small bullish candle, and followed by this massive bearish candle downward, which has this wick right here. So this massive bearish candle was responsible for creating the high. So this is a candle you're actually going to use. So you have to use the whole of the candle. You have to use the whole of the candle. You don't aim for price to come all the way to this other block. It doesn't have to come all the way to this other block. It just have to come into the zone to continue the bullish momentum. So now let's see what actually happens at the end of the day. And as you can see, price has tapped into our supply zone. This signifies that price is about to go bearish, right? So if you want to get into a trade, the first method is simply to use the 50% level, right? So I'm going to set my entry. Okay. I'm going to set my stop loss right here. I'm going to draw my TP all the way down to this point right here. Now this is going to be a 1 to 8 risk to reward ratio. Now the first method is just using the 50% level. Now what if price does not come to the 50% level? Because that is just a probability. Price doesn't have to come and respect your 50% level. Price just needs to tap into the supply and demand zone. Now this is where the second method comes in. Now if price doesn't get to my 50% level, what I most times do is use what I call a double confirmation. Now immediately price went all the way up and tapped into the supply zone. I know price will go all the way down. So I use this range right here to find structure. So I'm going to use this range to find a setup. So all I need to do is just look for a break in market structure. And now we have a perfect break in market structure right here. So as you can see, price has been going all the way up right here. And there was a little retracement right here. Price went all the way up, right? So price came down, price went up, and price broke structure. So I have a confirmation that price from this point onward will start to go all the way down, right? Now this was actually a steering breaker. Steering breaker is just when price breaks too low in the market. It's just like ICT's break of structure, but it's slightly different. Okay. So let's say, for instance, price has been coming all the way down, right? So suddenly there was a break in market structure, but instead of breaking just one single high, price in order to become a steering breaker will break two highs. So basically the order block below will become a valid steering breaker. So price will respect that order block. Now this is for the bullish momentum. So for the bearish scenario, it's just upside down. Now this is the bearish scenario. So as you can see, price broke two different low, making this order block right here a very, very valid order block. This order block right here. So this is a very, very valid order block. So when you see a confirmation like this, all you need to do is to strategize. So you can either do two things. You can either leave this right here just in case price ends up coming up to the 50% level, or you can just delete this and use this right here as your new trade setup. So let's try to set a position right here. So this is going to be a stop loss. This is going to be entry. And if I go all the way down, you just have to use the last low as our TP, right? Now this is an incredible 1 to 13 risk to reward ratio. Now this is massive. Now let's see what ends up happening at the end of the day. Okay, as you can see, price tapped into the order block, right? So immediately price broke these two highs. Price retraced back up into our order block. So price kicked us in and price started going all the way down. And this was a massive sell-off all the way down. By the way, this is a 1 day time frame, so it's kind of crazy, right? So let's see what actually happens at the end of the day. And you can see price finally tapped into RTP. Now this is a 1 to 13 risk to reward ratio, right? So it's that simple. All you have to do is just highlight your zone. Now first, price came all the way down. We set our zone and price entered into our zone, and we got a trade setup, and we patiently wait for price to get into the next zone. Then we found a trade on this zone and price went all the way down. Price retraces and we enter into our third trade. So that is all you have to do. All you need to do is just trade like the banks, and this is how the banks actually trade. They push price downward, and in order to continue the bearish momentum, they make price to retrace all the way up for price to continue the bullish momentum. So it's same thing for the demand. This is the supply. The demand is just inverse. I can either use two methods to get into a trade. Either you use the 50% level of your supply zone, or you wait for a double confirmation. So it's that simple. I really do hope you find this video helpful. If you have any single question at all, you can type in the comment below, or you can reach out to me on WhatsApp, link in the description below. Now, if you're yet to subscribe to the channel, do make sure to smash that subscribe button. Thanks for watching this video, and see you in the next one.